All right. So now I'm going to talk to you about the exchange differences which are to be included in borrowing cost. So we discussed the concept, right? This exchange difference very briefly to say that if you borrow money in your currency, in a currency which is not your functional currency, but you have borrowed money in a foreign currency, you will end up borrowing money at an interest rate which is lower than the interest rate which you pay in your functional currency. However, then you are exposed to the currency risk. If you are exposed to the currency risk, the standard permits you to also look at that currency loss. If you have, there also a possibility that you actually may have a currency gain, right? If you have a currency gain, that anyway straight away goes to profit and loss account. That is not required to be considered under Ind AS 23. However, if you have a currency loss, then that loss, to the extent of the interest which you have saved on your foreign currency borrowing compared to a domestic borrowing, that is eligible for capitalization. And then there are some more complexity to say that if in one period you had a loss, in subsequent period you had gain, how do you deal with all of that is what we will try and understand. So for exchange differences required to be treated as borrowing cost, the manner of arriving at the adjustment stated therein should be as follows: amount of the exchange loss not exceeding the difference between the cost of borrowing in functional currency when compared to the cost of borrowing in a foreign currency, right? And we try to explain this with the help of a very simple example to say that if I were to borrow $100, and let's say rupee dollar exchange rate is 50, that means I wanted to borrow 5,000 Indian rupees. Now I can borrow, if I were to go to a bank in India, the bank will say 5,000 rupees, I'm going to charge you interest at the rate of 10%. Here I went to an overseas lender and say I want $100. That bank said, okay, I can give you $100 and I will charge you interest at the rate of 6%. The 4% delta, right? The 4% which I have saved between this 10% and the 6%, right? Now we are talking that this 4% saving, the 4% saving which you have made, now this 4% saving, if this 4% saving which you think you have made, you are now exposed to the currency risk. You are exposed to the currency risk. Now in this currency risk, there is a possibility that you may lose money, you may gain money. Now if you were to lose money, your losses to the extent of this 4% is what can also be considered as borrowing cost, which is eligible for capitalization under the Ind AS 23 model. So we will try and understand this. Now if there is an adjustment of exchange loss, adjustment on account of exchange loss, adjustment of exchange loss shall be the difference in your cost of borrowing in functional currency versus cost of borrowing in foreign currency. Let me just try and do this. Yes. Let me just clean this stuff for you so that you can see this. Okay. All right. So now the adjustment of exchange loss shall be the difference in cost of borrowing in functional currency versus cost of borrowing in foreign currency. So in my example here, this 4% is nothing but the difference, the cost of borrowing difference in your functional currency versus cost of borrowing in the foreign currency. It is what is to be considered. It is what is to be considered. And we will try and understand this, right? We will try and understand this with the help of an example here. Let's look at this case study. Okay. All right. So this is in relation to, capitalization of foreign exchange fluctuation, right? Under Ind AS 23. So if you, essentially what we're trying to say here, that if you have borrowed money, which is in a currency other than your functional currency, and why will you borrow money in currency other than your functional currency, right? Essentially because you may have a
interest rate arbitrage. So you end up paying lower interest on that, and then but what happens that you are exposed to the currency risk. So if your home country currency or the functional currency in a way depreciates against the foreign currency, then you have an exchange loss along with the interest what you need to pay. So what Ind AS 23 principle, as we've been talking, essentially suggests that if you are actually when you look at the capitalization of interest cost, right, in relation to a qualifying asset with relation to a borrowing which you have, and if the nature of the borrowing is a foreign currency borrowing, then you should look at the capitalization, not only the interest what you're going to pay in relation to that foreign currency borrowing, but also if you have exchange loss, to the extent that the sum total of the exchange loss and the interest cost do not exceed the amount of interest which you are otherwise required to pay if you were borrowed this money in functional currency or in your domestic currency. So we'll try and understand this, right? The same concept with the help of the example. So Good Group Limited, an Indian manufacturing company, has taken a foreign currency loan of $2,000 on 1st of January 2019 for construction of a facility. The interest rate on the same is 5% per annum, payable on yearly basis. The exchange rate on the respective dates are as below. 1st January 2019, $1 equals to INR 45. 31st of December 2019, $1 equals to INR 48. That means there is a depreciation by 3 rupees. All right. Okay, and how much is the interest rate I'm paying? Interest rate I'm paying is 5% per annum, and how much money I've borrowed is $2,000. Okay, a loan from a local bank for the same amount, terms and tenure was available at a rate of interest of 11%. So essentially, if you look at the interest rate arbitrage which I have here, is this 6%. Okay, that's the interest which I'm saving, is because I borrowed money in foreign currency, but I've lost 3 rupees, right? Now I have to pay more, local currency in a way to discharge my obligation. Now the question here is, what is the amount of borrowing cost to be capitalized as per Ind AS 23? So what do we need to do here? We need to compute the amount of total interest cost, which I would have incurred otherwise if I would have borrowed money in domestic currency, okay, which is at the rate of 11%. $2,000 multiplied with 45, I get to, so $2,000 at the rate of 45. That is the amount I'm looking to borrow, right? And then which is 90,000, right, at the rate of 11%, right? So that is what is eligible for capitalization. That's not eligible for capitalization. That's the total interest cost which is eligible for capitalization. Okay. Now I'm going to compare my actual kind of cost. So actually, I am paying here 5%, right? And then on $2,000 at the rate of 5%. So essentially, I'm going to pay $100. Okay, $100 at the exchange rate, which is 48. So which is 4,800. And then there is a $3 loss on this, which is $6,000, right? $2,000 into 3 is what I have lost. So total actual cost, though the interest, right, at the rate 11%, which is 9,900, right, in a way. So when you look at the actual cost which I have incurred here is 10,800, right? So let's look at the solution. Let's look at the solution. Okay, as per Ind AS 23, along with the interest expense on the loan, borrowing cost also include exchange differences arising from foreign currency borrowing to the extent that they are regarded as an adjustment to interest cost. Now, interest on US dollar loan for the period 2000 into 5% is $100. We talked about it, and then converted to INR is 4,800. So $100 right? Into 48 is equal to 4,800 rupees. And then there is an exchange loss, increase in liability due to change in exchange difference. That comes to $2,000 INR into 48 minus 45 is 6,000, right? So the total cost is 6,000 plus 10,800, as I was saying, right? Now, when you look at the interest expense, if the loan were taken in local currency, right, which is 2,000 into 45 into 11% is 9,900, 9,900. So you're going to compare this with 9,900, and lower of the two is eligible for capitalization. So essentially here 9,900 is what? So I will going to capitalize 4,800 of interest, and also on exchange differences out of 6,000, I will be able to in a way capitalize out of 6,000. I will be able to capitalize up to the difference between 9,900 minus 4,800. Okay, so let's look at that. So difference between interest on a foreign currency borrowing and local currency borrowing, which is 9,900 minus 4,800 is 5,100. Okay, so I have a total interest cost, I have a total foreign exchange fluctuation loss of 6,000, out of which 5,100 is allowed to be capitalized. That means 900 is required to be charged to expense. So out of total exchange loss of 6,000, okay, on principal amount of foreign currency loan, INR 5,100 is regarded as an adjustment to interest cost and hence to be considered as borrowing cost. Total borrowing cost to be capitalized is as under interest cost on foreign currency borrowing 4,800 and exchange differences 5,100 get to 9,900. Okay, now the exchange difference of 5,100 will be capitalized as borrowing cost, and the remaining INR 900 will be expensed off in the statement of profit and loss account. Now this distinction is important, right? That how much is on interest and how much is on foreign exchange, because we're going to see in the following example, right? In a subsequent example, which we will do, is that an interest rate at the exchange rate, as you know, they are subject to change at every measurement date. They change. So you could have a gain in one period, you could have a loss in another period. So how do you deal with all of that is what we will try and understand with the help of a very detailed example.
So exchange differences to be included in borrowing cost are unrealized exchange loss treated as an adjustment to interest, and subsequently there is a realized or unrealized gain in respect of the settlement or translation of the same borrowing. The gain to the extent of loss previously recognized as an adjustment should also be recognized as an adjustment to interest. Let me explain to you. I mean, we have an example as well, but I'm going to just quickly take a minute and help you understand this, right? Now, if you look at the same example which we talked about, right? I had this, on 31st March 2019, when I borrowed this, it was 45. Then on 2020, it was 48. That means there was a loss of 3, right? Now, if I fast forward this to 2021, it is possible that it may go back to say 46. Right now, here from this period to this period, now there is a gain. This is a gain and this was a loss, right? Assuming this loss 3 is what I have capitalized, then what we are simply saying that this 2 gain which has happened in this period, you are actually required to decapitalize the interest cost which you capitalized in the previous period, provided the construction period is still on. Now, if the construction period is complete here only, then you stop. It doesn't matter to me now anymore, because it is no longer a qualifying asset. Now, if a qualifying asset continue to exist in relation to which you have capitalized this, now that then this 2 rupee gain, you got to then decapitalize the previously capitalized amount. But if the construction is complete, you are done, from that perspective, or if you've already repaid the loan, then anyway you don't get any foreign currency gain here, so on and so forth. So you got to understand this concept very. Now, assuming, let's say, this actually instead of 46, this actually has become 44, right? That means I have a 4 rupee gain with reference to 45. I have a 4 rupee gain. Now, if you have a 4 rupee gain, then only to the extent of this 3 rupee loss is what we are saying that will be considered as an adjustment to the interest cost. This 1 rupee gain over and above this 3 rupees, that is actually an exchange gain to be recorded in your financial statements. All right, it's slightly, you got to remember some of these principles, apply the logic. That is very simple. If I would have borrowed money in local currency, I would have paid interest at the rate of 11%. I had access to this foreign currency market and I was able to borrow money in foreign currency, where I was only paying interest at the rate of 6%. So this 5% delta is actually my saving. Now I have saving here on account of interest cost, but because I borrowed now money in a foreign currency, I've exposed myself to an exchange rate risk. The standard suggests that if you are exposed yourself to an exchange rate risk, and if you have a qualifying asset which is out there in your balance sheet, then the exchange rate loss which you incur in relation to your borrowing, to the extent of the interest saving which you could have potentially have if you would have borrowed money in a domestic currency, that should be considered for the purpose of capitalization as akin to an interest cost. And if in one accounting period you had an exchange loss, in another accounting period, if that qualifying asset continue to exist in the construction phase itself, and if you have a gain in the subsequent period, then the gain to the extent of previously recorded loss, that should get offset against each other, and hence you're going to decapitalize. You're going to capitalize in one period, you're going to decapitalize in another period. Over and above the loss which you previously recorded, the gain is much more than that, then that is actually an exchange gain which you will record in your balance P&L as a foreign exchange gain, and appropriately, of course, revalue that liability in your balance sheet as well. So we're going to further try and understand this with the help of this example, right? An entity can borrow fund in its functional currency at the rate of 12%. Functional currency is INR, and we will talk a lot more about the functional currency and foreign currency when we will discuss the concept under Ind AS 21. I will do a very detailed discussion on functional currency and foreign currency. It borrows $1,000 at the rate of 4%. So if I would have borrowed money in my functional currency, I would have borrowed money at the rate of 12%. I have access to dollar borrowing, and here I can borrow money at 4% when rupee dollar was 40. The equivalent amount in functional currency is nothing but INR 40,000, right? Which is 1,000 into 40 is 40,000. Interest is payable on March 31st. On 31st March 2020, the exchange rate now equals to INR 50. The loan is not due for repayment, right? Now the rupee dollar has moved from 40 to 50. It's a very, very substantial movement, right? 25% is the erosion in value of rupee vis-a-vis dollar, right? Now, the question is, when you look at this, right, how do you determine what is the extent of exchange loss which can be considered as part of your interest cost? The exchange loss in this case is INR 10,000, right, which is $1,000 into INR 50 minus 40 is 10 rupee loss per dollar, so which is 10,000 is the loss. The borrowing cost is INR 2,000, which is $1,000 into 4% into INR 50 is what I'm paying as an interest cost. Had the entity borrowed money in the functional currency, the borrowing cost would have been how much? What rate I can borrow money in my functional currency is 12%, right? I can borrow money at the rate of 12%. So if I would have borrowed at $1,000 at the rate of 40, right? How much I would have paid is 40,000 multiplied by 12% for 1 year is 4,800, right? 4,800. So now against this 4,800, I've already paid now interest of 2,000, which is at the rate of 4% multiplied by INR 50 prevailing rate on the date when it is due. The entity will treat the exchange difference up to INR 2,800. How much is the exchange loss I have here, right? My total exchange loss is 10,000 rupees, but exchange loss to the extent of 2,800 as a borrowing cost that is eligible for capitalization under this standard, right? So total eligible borrowing cost is INR 4,800, equivalent to the cost of borrowing in functional currency. So let's look at another scenario as part of the same example. So all facts are same as scenario one, which means what? I borrowed $10,000, at the rate of 40, except now the closing exchange rate, which was 50, that has been revised to here in this is assumed as 41, right? So now I am going to compute my interest cost. So my borrowing cost on $10,000 at 4% at 41 is 16,400. My exchange loss is 10,000. So my total cost here is 26,400. And I'm going to compare that with 48,000, right? The 48,000 which I had. So now 26,000 is lower than 48,000. So entire 26,400 is eligible for capitalization, right? Alex Morgan recognized exchange loss of 10,000 as borrowing cost. So entire thing is allowed to be capitalized. Awesome. So I'm going to follow it through with another scenario. Let's look at this scenario. So we're now going to make it a little bit more complex. So now all facts are same as in scenario one. Scenario one, remember, right? So we borrowed $10,000 at the rate of 40, right? And paying interest at the rate of 4%. Now, additional information on exchange rate on 31st December 2020 is provided as $1 equals to INR 48. So we had first 50, then we moved to 41, and now we are back to 48. Again, a very steep, in a way, depreciation of Indian rupee in this example. So again, I'm going to compute my borrowing cost, right, which is $10,000 into 4% into 48. That translates to 19,200. And I have an exchange gain for the year, right? I have an exchange gain for the year. So here, actually, this is for 31st December 2020, right? So we were doing for 31st December 2019, okay? So my scenario, the original scenario was 31st December 2019 when rupee had depreciated from 40 to 50. Now what has happened here? So this was at the beginning, right? Which is January 19. Now we get to December 19, and now we are at December 20. Okay, so now the rupee has appreciated by 2 rupees. Okay, so the borrowing cost, and that's why these dates are very, very important for you to focus here, right? So borrowing cost for the year ended 31st December 2020 is 10,000 into 4 into 48. That is okay. Now there's an exchange gain of 2 rupees here. So which gives 20,000. 10,000 into 50 minus 48. So $10,000 and 2 rupees, in a way 20,000 rupees. So in a way, my net cost in this year, okay, is actually negative, right? If I look at 19,200 of cost and 20,000 of 19,200 and 20,000 of gain, right? This is minus, this is plus, so we get to 800, right? 800 of saving, okay, 800 of saving. But let's look at how do you look at from a accounting perspective. Remember, we had a huge loss in year one, right? In that example, and we couldn't capitalize the entire exchange loss. Okay, so the above exchange gain of 20,000 will be adjusted against the borrowing cost, as exchange loss of INR 28,000 was recognized as interest in the previous year. So to the extent I had recorded the exchange loss, which was INR 28,000, I'm going to first offset it against
that, right? That's how the principle is going to work. So essentially, in this year, I will have, there is no interest capitalization. In fact, there will be a reversal of 800, right? There will be a reversal of 800 because the 20,000 is going to get reversed against the 28,000 of exchange loss, which I had already capitalized. Okay, so let's look at another scenario. Okay, all facts are same as in scenario 1. Additional information on exchange rate on again 31st December 2020. So we had January 19, and then we had December 19, and now here we are December 20. Okay, all right. So now here the exchange rate is $1 equals to INR 44. There is a steep, in a way, appreciation now. So it has moved from 40 to 50 to 44. Okay, let's look at how we're going to deal with this. So borrowing cost again for the year December 2020 is fairly simple, which is 10,000 into 4% into 44. We get to 17,600. Okay. Now exchange gain, there's a 6 rupee of exchange gain. That means 60,000 rupees of exchange gain. Out of that, 28,000 will be adjusted against the borrowing cost and the balance. Okay, so 60,000 minus 28,000. 28,000, remember, is what the exchange loss which we had originally capitalized. So this is equal to 32,000 is actually a foreign exchange gain. Okay, so 32,000 is a foreign exchange gain, will be recorded in the statement of profit and loss account. All right. Okay, I hope that that's making sense to you. It's likely you got to look at the principle. Okay, so the principle is that I have to capitalize interest cost. Okay, and if I have borrowed money in foreign currency, I'm also allowed to look at exchange loss. Exchange loss to the extent it offset the interest cost. Now interest cost in if I would have borrowed money in domestic currency. Now, if in a subsequent year the loan is still outstanding, that exchange loss which I had capitalized turns reverses into exchange gain. So the exchange gain to the extent of exchange loss is required then to be adjusted as part of the capitalized interest cost. Anything over and above, in a way, is a normal exchange loss on revaluation or remeasurement of such monetary liabilities. Okay, let's look at one more scenario. Okay, so assuming, let's say, there's been a partial repayment. Okay, so exchange rate on 31st of December 2020 is 44. Exchange rate on 19 was 50. Now $6,000 of the borrowing was repaid on 31st of December 2019. So we had borrowed how much? Total 10,000, right? Out of which 6,000 has been repaid, and the balance 4,000 of the borrowing is not due for payment. Okay, so that means the 6,000 has been paid. Okay, so we had whatever we had capitalized, we had expensed, all of that is done and dusted. So we only left with 4,000. Okay, so how much is my borrowing cost for the year 2020, right? So which is only now $4,000. So 4,000 into 4% at the rate of 44, which is the exchange rate here. That number gets to 7,040. Now how much is my exchange gain here, right? So 50 was 4,000. So 50 minus 44 is 6 rupees on 4,000. That is 24,000 is my exchange gain, right? Now I need to remember that out of 28,000 of the exchange loss, which I had capitalized, how much actually in relation to the $4,000, okay? Because 6,000 has already been paid back. So that's history, okay? So the exchange loss was 28,000 in total, right? 28,000 in total. So 4:6 ratio, essentially, right? So what is the so exchange gain, which is 28,000 into 4 by 10,000 is how much? 11,200. Okay. So out of the total exchange gain of 24,000, which I have, 11,200 will be adjusted as part of the interest cost,
and in a way will result into a reversal of the previously capitalized interest cost. And balance, right, 24,000 minus 11,200, which is what, 12,800, right? So 12,800 will be recorded as a gain in the P&L as part of exchange gain or loss. All right. So I think we've looked at several scenarios, and the bottom line here is you got to remember that Ind AS 23 allows the foreign exchange loss in relation to a foreign currency borrowing if you have a qualifying asset, to the extent that foreign exchange loss is actually compensating because you borrowed money at a lower interest rate. It's compensating if the money would have been borrowed in the local currency, the saving of interest to that extent, that is allowed to be capitalized, the lower of the two. Okay. And in the subsequent years, if that situation has reversed, then you got to also reverse, adjust that exchange gain in the subsequent period to the extent of the exchange loss which was capitalized. So in a way, you'll have to maintain kind of detailed ledgers around this if this is a long-term qualifying asset. All right. So several things which we talked in this section is that the recognition, the definition, right, as to for what purpose it is relevant, from that perspective. So what's the purpose of this standard all about? The purpose of this standard is to help you assess how much is the borrowing cost. Now, once you determine borrowing cost, the question is that what portion of borrowing cost is eligible for capitalization in relation to a qualifying asset. So we talked about borrowing cost, and then when we talked about borrowing cost, we said any cost which you incur in relation to a debt which you have on your balance sheet. We also talked about exchange loss, which you incurred in relation to a debt which you may have borrowed in a currency other than your functional currency. So to the extent of interest which you have saved in relation to your borrowing cost, which you have borrowed in a foreign currency, that is also forming part of your borrowing cost. And also we took example around lease. Let's say if even if it's a notional or imputed amount of interest in relation to your ROU liabilities, that also is eligible part of your borrowing cost. We also said if any return which you are paying to equity holders, that's not to be considered as part of your borrowing cost. Equity holders for instruments which are qualified and sitting in your balance sheet as part of your equity box. But if there is an equity shareholder which is given loan also to a company and also subscribe to the share capital, and on the loan you pay interest, now that interest is eligible to be considered for the purpose of borrowing cost. And then we talked about qualifying asset. What is a qualifying asset? Is something which takes substantial period of time in relation to its construction or for production, for it to be ready for its intended use. And the substantial period of time has not been defined in the standard, but it is generally presumed to be a period which takes more than 12 months. A period which takes more than 12 months. So once you've understood the concept of a qualifying asset, which could be building an office building or office headquarter or a factory building, let's say or if it is an inventory which takes substantial period of time for you to build, like a ship or something, all of that in a way qualifies as an intangible asset. And this thing goes to the genesis of what is the cost which is eligible for capitalization under Ind AS 16 or under Ind AS 38 model for tangible asset or an intangible asset. And interest cost is also an eligible item of cost which is eligible for capitalization. Here under Ind AS 23 standard, we're trying to determine how much of that cost can potentially form part of the capitalization. There are certain scope exclusions which we talked about, which is to say that if it is a biological asset, you are not supposed, which is accounted for at fair value under Ind AS 41, they are not, these are not going to be qualifying assets. If the inventory is made in large quantities on a repetitive basis, they're also not eligible qualifying asset, which you need to consider. So there are scope exclusions, and we talked in detail that if there is a foreign currency borrowing and if there is an exchange loss which you incurred in relation to, or even if it's an unrealized or realized exchange loss, such exchange loss to the extent of interest saved on your, if you were to compare this with your potential domestic borrowing, to that extent, that exchange loss is also eligible to be considered as part of your overall borrowing cost. And we use several examples to explain you the whole scenarios as to say this. If you borrowed money when the exchange was 40, then it moved to 50, then how do you deal with that? If it moves to 48, then how do you deal with that? If it moves to 41, then how do you deal with that? So on and so forth. So we try to explain this with very, very comprehensively, the impact of foreign currency, right? It's an area which is slightly complex, but if you were to apply the principle that exchange loss to the extent of interest saved, and interest saved vis-a-vis if I would have borrowed money in my domestic currency vis-a-vis the money which I borrowed in foreign currency, that exchange loss to the extent of interest saved is eligible to be considered as part of my interest cost. Now, if this exchange loss which I've incurred in one period gets reversed in the subsequent period, then that also is required to be reversed from the interest which was previously considered. However, if I have repaid that loan and that unrealized loss is actually got converted into a realized loss, then anyway there is no decapitalization which is required, because it just got settled. In the future period, any loan which is outstanding to that extent, to the portion to which I had actually considered for capitalization, only to that extent, any other foreign exchange gain or loss over and above which is to be considered as part of Ind AS 23 is to be dealt with under Ind AS 21, and we will cover in more detail the assessment of foreign exchange gain or loss, or a foreign operation, or functional currency or foreign currency. All of those concepts we will deal in detail when we will discuss Ind AS 21.